Papa Bear in his suit, Wall Street goes, teaching young cubs how to play the role. Market watch, stacking cheddar.
Welcome back to Noob's Noob. My name's Noob. I'm here with Abraham Jaden, and we are going to be placing an earnings trade. You'll notice that Jaden's account is higher this morning. We actually placed an earnings trade and reported it yesterday going into today, but we had some issues. So we had some technical issues with the recording. So why is this cutting off the top of the group steps? All right. So hopefully this will go more smoothly this time. So we're going to be placing another earnings trade today. Let me get the earnings calendar up here. Go to earnings whisper. So if you're trading earnings, there's a good resource out there called Earnings Whisper. Google this, and you type in the date, you will get this week. So these aren't all the companies that are having earnings, but they are the most liquid ones that are having earnings. So we have, after the close tonight, we have Tesla and Google, Visa, Seagate Technology, Capital One. The ones that I think we'll probably be focusing on are Seagate, Visa, Alphabet, and Tesla. Go ahead and pull up Tesla button.
What's the thing?
Yes, something. You're gonna pull up. It's not on. Look at you. This is a better chart if you look at here of Tesla. This is a 20-day chart. Go back down to the yearly chart. So it's on a map that looks like move from a breakout around the $200 level. And the lows this last recent year are 138. So with that in mind, we're going to look at some trade possibilities here with Tesla. Now, all right, you're looking in. So with this being a huge stock, the way that is, you can trade the weeklies like you were looking at, or you could go further out in time. With this being such a large price stock and your account being such a small account, I would recommend we look at that's right that you were just on. So 16 August, 24 days out. That's going to let you get further away from the stock price if you decide to sell anything. Roll down. Tesla's a very volatile stock. The brokerage is going to want you to put up a lot of capital if you trade this. So you can trade it naked. If you do trade it naked, I would not be putting anything on to the upside. I would simply be selling. Because when this thing goes to the upside, they just dump premium into these contracts. So you'll be losing if you sell and this thing works to the upside. You'll be losing on that call. So go ahead and go back down or back down in price. Go to these split strikes. So right here for the 185 or the 180s, we can collect around $60, $80 or $100 for the 190. That means that you're willing to buy the stock at 190. That's 100 shares at 190. That's $19,000 worth of the stock. It's a lot of stuff. Big position. Um, if I were you and something like this, I would just be looking at something like maybe the 180 for like then 60 cents puts you at the affordable position should you have to buy this time. Little up your entire account, but it's still a large facility for your account. Probably too big for your account, but so let's look at some of the other trades that we had here. There was Alphabet. This is a better price stock. It's actually similarly priced to Tesla. Type in GOOGL. Go ahead and look at that. So begin with this. Let's stay on that 24. Yeah, no, this is again a $180 stock. So let's stay on that 24-day cycle. Scroll up. All right. Bring up the well before we do that. So you're looking at any juice on this, you're looking all the way at the 160 strike into the upside, you're looking at about the 210. This is a stock that doesn't move nearly as much as Tesla does, so I would be more comfortable with you guys selling something like a 210 160 strangle in here, and that's probably only going to cost you about $2,000 to put that on. So go ahead and click those two.
Yeah. The bids,
The bid, yeah, for selling it, click the bid.
210.
So now go ahead and hit next. See what we got. Collect about a buck 30 view. Now we're putting this on for 24 days, so 1,800 bucks. Yeah, much more affordable than Tesla. Tesla would have cost you about $5,000 to put that on, somewhere between 3,500 and $5,000. Put it in the back. Again, if you look up here, see this IV percentile right here.
Mhm.
You see it?
Yeah.
81%. So this means the IV in this particular stock is higher than it was 81% of the time throughout the previous year. That's a good candidate for selling volatility. So I like this particular trade. You could also add protective wings, go $10 to the downside, or even $15 or $20 to the downside, and cap your risk if you wanted. I don't think I would in this particular position, maybe to the upside. I just leave this naked and cap your risk to the upside. So maybe sell like the 230. So limit your, I'm sorry, buy the 230 or the 225 or the 220, anywhere in here.
Like that.
If you did something like that, yeah, you're capping your risk to the upside now and not capping the risk to the downside. So from the 210 to the 230, that says I'm not willing to lose more than $2,000 if the stock rips higher. And for that, you're giving up about 15 cents. If you're willing to give up 30 cents, you can cap it to 1,000. That would, you would be taking in about a buck, and then you're only risking 900 to the upside. I probably like that, something like that. Take that one off and do that. So there you're only, if you get blown out to the upside, you're capping how far it can go. Now let's look at, you want to look at Visa? I don't think I'd be trading Visa in these markets. So let's look at Seagate Technology. Seagate, their manufacturer of, I believe they sell hard drives, SDX. X.
STX.
Yeah. You paying attention, Nate? Because you're going to be putting this trade on after he's done. That was the question. Are you paying attention? Can you sit up to your camera? Pay attention. Yes. All right. This is a much lower price stock. Volatility again, IV percentile here is still high. It's a good candidate. Raw IV, not crazy, but manageable. One thing you'll notice here, go to the at the money, please. Go up a little. One thing you'll notice here, these markets are maybe a little bit wider than something like a Tesla. So this is 20 cents wide from the bid to the ask. Again, 20 cents wide, 20 cents. the wider markets here, getting in and out, you're going to have a harder time getting filled. You're going to give up a little bit more money, but there's still a lot of juice in here. The expected move, scroll all the way up so you can see what the expected move in here is. Expected move for the next 24 days is about $10. Seagate, let's get the chart up here. Seagate here. What is it? SDX? Show everybody what the yearly chart looks like. Not a crazy mover over the last year, though. It has basically doubled over the last year. But you can see from month to month, the rallies are right here. $15 here again, 89 back up to 105 or so. So when we get strong rallies, you're looking at maybe $10 to $15 moves in here. So let's see what 1.5 times the expected move strangle here would give us. Down, it's trading at 105, so $15 to the upside.
What is that?
And 20 strike, you're looking at about 60 cents. Not terrible. Look at and into the downside, you're looking at a 90 strike. Even less. So there's call scooping here, you're getting paid more on the. So you could do like do the 90. Overall credit is what? Hit next. Doing that for $1, and I'm imagining that this is probably only going to charge you put this rate on maybe $1,200 or less. 1,000. This again is a more appropriately sized position for your account. And you again with this, you could add wings, go back. So with that in mind, what are you guys thinking as far as those stocks? We're not going to look at these, so we're just going to keep it to these three. This one has a wider market than the other ones. Google, it's a little bit higher price and require more capital. It's not usually a huge mover, but it could move maybe $20 on there. That's within the realm of possibility. So what are we thinking? Or do you like more Apple or Google, Tesla, or Seagate?
I like the Google.
Google? Okay, go back to Google. And then what did you want to put on here? Did you want to take naked risk or defined risk or a combination of both?
It's a combination. What was it?
We looked at, well, first go to the expected move. I don't think we covered the expected move in here. It's all covered. You have to move $15 in that time frame. Okay, close that or like. Okay, so $15 higher. If we're doing 1.5 times the expected move, you're looking at about $17. So pretty much at 200. But we can get further away from that. I don't think you need to get that close. I would be more comfortable with somewhere around the 210, 205, 210.
Yeah.
Okay. Go ahead. Look it. Did you want to?
And then we're gonna do this.
You did.
Yeah.
Then to the downside. Have 60. So this is actually $22 away. You could do the 165, but that's not a full 1.5 times the expected.
I don't know.
You're taking on more risk, and you're possibly going to be buying Google at 165 if that thing goes down.
We'll just do the 160.
Next, capital required to put this on. So you're doing it for $100 even. Hit review. The $1,800, and that's because that put is not defined. We didn't define the risk on that side. So you're only risking 900 to the upside, but it could fall to like 150 or 140, and then you're having to buy it at 160. So that would be a $2,000 loss minus your $100 credit or $19 loss if it falls to 140. All right, so hit send. Instantly filled, and there we go. Abraham, you want to load your screen in here? Get yours up. Hey, by the way, I got out of your earnings trade this morning for you. It started off with being a $250 loser and closed it for a positive scratch, meaning you made like $8 on the thing.
On mine.
No, $70.
Oh.
Because I closed it. If you close it now, you would, it was a loser earlier, later on in the day. It moved against you. That's why you need to be there to decide what you're gonna do when the market opens. Because I closed it, we opened it for, I think we sold it for around $100 or something like that, 120, and I bought it back for 20 cents this morning or 25 cents.
What
But
does it say?
if you were to go do it right now, it wouldn't be the same. What spot? I got out of spot. What's that?
Well, it's right here.
Yeah, I got out of it. Open it back up. See how it says 0 contracts? I got out of it. You got a $12 winner in there. And actually, if you go back to spot, if you had held on to it, it would have been $120 winner. Right now, because we sold this for $2. Now it's only worth 79 cents, 80 cents. So you could buy both these back for about 81 cents and you'd be up 119. But because of the really strong move, I was happy, and being down $250 to start with, I was happy to get you out of that position for a scratch. Also, this was too big of a stock for you to trade in this account naked on both sides. Because what happened was this was trading around $300. When it rallied up and got close to your strike, it was trading on the open, it was trading at $343. The brokerage firm said there's a lot of risk in that because you're very close to your strike. So they wanted another $4,000 in your account to maintain that position. Remember, it cost us $3,000 yesterday to put it on. But because of the big move in the stock, they wanted like around 14,000 to keep it on. So you would have had to get out of that. You wouldn't have been able to take that into the next day. So that means that if you're going to trade a stock that's volatile like this, that's this big in the future, you're going to have to define your risk. Too big of a position. That was a learning lesson for me. I'm not used to trading in a smaller account. All right. So which stock did you want to do?
I was thinking we do one.
You go as well?
Mhm.
Okay.
No.
Yeah, GOD. Yeah. Make sure you're talking into your mic. All right. What did you want to do in here? So you're going to do the 24-day cycle as well?
Yeah.
Okay. This is the 3-day cycle here.
What was the other one you said?
Seagate,
No, the other.
Tesla.
No, the other options.
Tesla,
No, not the stocks. I mean the things we're talking to Jane about the
the what? I'm sorry.
like the different positions you put on.
Oh, well, you mean the time frames or the different positions?
Different.
So you can sell, you can cap your risk. You can sell, well, first of all, you can take risk on only one side of the market. So it's trading at 180. You can bet that it's going to go up or you can bet that it's going to go down. Or you can take risk on both sides of the market and bet that it's going to be within a range. You can do that naked, taking more money up front, or you can define your risk and you give up a little bit of that money to define the amount that you can lose. This one I think is around, what was the expected move in here? think we ended up going out to 210, which is, I mean, $30 away from the expected move. I think that's twice the expected move. You don't have to go out to 210. You can go off of strictly delta. So scroll over to the right and find strictly delta. If you wanted to do like a 16 delta strangle, that would be the 200, and then that would put you somewhere around the 160. I'd give you like a 16 delta on both sides, or you could go for like a 20 delta, sell something closer like this. Actually, a 16 delta on this side is somewhere between 165 and 170. Actually,
So it'd be like right here.
if you is this a 10 delta? I can't read that. What's that say? 18?
Yeah.
So if you, I would probably do the 205, but you could do this strictly 18. Don't click it yet. Just decide which strike you want because you're buying. So if you did a 12 delta on this side and a 13 delta on this side, that puts you about a 75% chance of a winner. So go ahead and scroll back to the actual prices. Scroll to the left. That was a 205, I think.
It was a 205 and 160.
165. So go ahead and hit the sell on both of those. Now, to do this naked, that's all you would do. So click next and see how much you're taking in. It's probably gonna be about 120 or 220. Yeah, 222, and then hit review, and it's probably gonna cost you about $2,000, maybe 2,200. 1,900. Okay. So back, you want to add wings.
What are wings?
Go back. Go back again. Now remember, this says we're agreeing to buy it here and sell it here. If it goes beyond that, you can buy protection, say $10 away. And that gives you the right. So if you have to buy it here, you can buy the right to sell it here at $10 away. So you're only taking $10. You're basically carving out a $10 section of risk in the market, where if it goes through that, then your only exposure is those $10. You're limiting your risk to, so go ahead and hit the buy on this $10 away here, this 250, hit this buy. The buy, not the bid, yeah.
Wait, what?
The ask,
Oh,
okay, then do the same thing on the other side. $10 away.
so
What are you doing? No, $10 away from the current price. Okay, if you ask. Yeah, the ask. You put last, it automatically defaults to a buy. So now you're giving up about 34 cents on that side, and then you're going to give up about 30 cents on the other side. So instead of taking in 222, click next again. You're taking in 150 because you're giving up for that protection. So instead of having an unlimited amount that you can lose now, if you go ahead and click review, the most amount that you can lose is about 850. You see how it says max profit is 148 and max loss is now 852. Scroll down. That's also going to be the capital required to put this trade on is 850.
what is this?
What is what?
Resulting buying power for stock?
That's day trading buying. So it's includes margin. They allow you to borrow some money to trade intraday. Or they allow you to borrow money to trade period, but you can borrow more for intraday trade. Right. So what do you think? You like that, or do you want to take unlimited risk and take in more credit?
I like that better.
You like this better?
Yeah.
Okay, we'll go ahead and hit send. You get billed, you did not get billed. So we're gonna hang on a second. We're gonna go to, yeah, you were right. Go up here to your tabs up here. Go to orders. Then you're gonna click on your order. And you're gonna go to cancel replace. then you're gonna tick down 2 cents on this. Then you're gonna reset it. You. There you go. You got filled, so go to your filled here, see what you got filled at what price. You got filled at 147, so we actually ticked down 1 cent too far. What's that?
Hmm.
You got filled at 147.
Mhm.
You ticked it down to 146, but there was an offer out there for 147, so it gave you the better price. It's called price improvement. So if you go into the market to buy something or sell something, and there's a better available price than your current price that's published out there, the broker's automatically gonna give you that better price first. All right, do we want to put on another trade? We can trade 2 earnings trades if you want. Especially since you did defined risk, and Jaden, you did defined risk on one side. You try one more.
Sure.
Which other stocks do you want to try?
What was the other one?
Not
the-
Seagate.
Height.
Tesla. Yeah,
What's the thing for Seagate?
that's TX. So why don't we just sell some really cheap? Why don't we sell a really cheap strangler? We do undefined but real cheap, far away from the price. The expected move, go back up. Let's look at the expected move one more time.
Where is it?
Up, 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 up. Go all the way up. Here. Right here, $10. So let's go $20 away. 2 times expected move. It's trading at 105. For the downside, we're looking at, what is that? 85. Ooh, there's nothing in there at 85. So we're gonna have to go to the closest liquid point. So 1.5 times the expected move would be 90. That's the closest place that you have any kind of liquidity in there, the 90 strike. Click that, the 90 strike. But we're selling puts on this side. This is the put side, this is the call side. Okay,
Mhm.
so we're selling the 90 put. This is wide markets in here. So scroll up. No, the other way, sorry. It's up in price. All right, so then from 105, $15 would be at 120. Look at 120 strikes is where we are. This side, there's a little bit of skew in here. You see how these markets aren't as wide and there's more interest in these out here. So what is the 125? Let's look at the 125. Go ahead and smack that up. But we're doing calls now.
So,
Huh? Calls now. Calls. So the puts agree to buy it. When you agree to buy something, you want to agree to buy it at a lower price. The calls, when you sell them, you're agreeing to sell it. You want to agree to sell something at a higher price. Remember that. Make sense?
mhm.
All right. So go ahead and hit, you see how this is 20 cents wide here? 15 cents now. I don't know what, you're probably gonna have to come in here and work your price a little bit. So go ahead and hit next. It'll automatically put you at the mid price of 70. So it's, hey,
Well,
go back. We're gonna pick that up to 75 because they're such wide markets. We don't want to get taken advantage of. So we're gonna slowly come in here. We try to get more for it right off of that. And then we're gonna work our price back if we don't get those. Because they're wide. Go ahead and hit review. $10,000 Diablo. We'll let that sit for a second. Hang on a second. Let it sit in there for 1 second and see if they fill us. And during that time, we'll let Jaden put on your second trade, and then we'll come back if you don't get filled. But sometimes you let it sit for 2 minutes or so, and the market will fill it. All right, what do you want to do for your second trade, Jaden? You have $5,000 available. GME, by the way, open your GME positions. That's now able to be bought back at 60 cents. I think you sold it at 110. It's almost 50%. And the stock really hasn't moved. So that's only been on for a few days. You might want to consider taking that off. Got 60 cents left to come out of it. I think you sold it for 110. So it's almost 50. Do you want to take it off or do you want to keep it on?
I don't know.
You still have 20 some days left in the contract and you made almost half in like 3 days.
Oh, then I'll just take it off.
Click it. Nope. Again,
Click the actual.
actual position, it closed. 63 cents is the mid price there. So take that down to 63. That's mid. Review. And you're filled. You're out of GME. You made what? 63 to 110. You made 40. Why is my math not mathing? What is that? 30, 37 cents plus 10 cents, 47. You made 50 bucks. Almost. All right. So now, which you want to do
C8.
this as well?
Yeah. I don't know.
Here. Let's do it. All right. So go to this cycle right here. Yeah, scroll down to this cycle. Remember, we're a $10 move here. Click the 105. Put the 100. Put the 100 here. This put, buy it. And then come up here to 110. Buy this.
By what?
Okay. Now scroll all the way back up. We're going to go to a different expiration. Come down to this near cycle expiration.
Which one?
This 3-day one that now go. Now put this. Put the. What do we? Scroll to the 98. Put sell on the 98. And then scroll again to the 112. Hit sell on that. So remember, in the 24-day cycle, we bought the 110 and we bought the, scroll down, what, the 90 or the 100. So we bought the right to buy and sell these shares $5 above and $5 below. And then we sold in the 2-day that expires tomorrow, the 98, and which is $2 below where we bought the right to buy it. We'll still have those contracts that don't expire for 24 days after these contracts expire in 3 days. So we went $2 beyond our long strike here at the 100, and then on the upside, go back up to the upside. We went $2 beyond our long strike here at the 110. We did all of that, spending money for the longs, selling and collecting money for the shorts. So go ahead and hit next and see what the total is going to be. We did $2 wide on both sides, and we're paying almost 300 for this. So I would rather go back. I would rather be closer to a $3 wide then. So go back and sell the 13 or 13 and then sell the 97. Now this is going to put the cost of this trade closer to 350. So go ahead next. 340, but we're $3 wide. So what's going to happen tomorrow is the stock's either going to go up, down, or stay the same. If it goes up, the value of that short put that we're selling in the 2-day or the 3-day is going to be worthless if it goes up. If it goes down, the value of the short call will be worthless. If it goes down small, both the call and the put short ones will be worthless. And if it goes up small, both the call and the put will be worthless. If it goes up or down large beyond our strike, then the call that we bought is going to either the call or the put in either direction. It's going to be start to behave as stock, and it's going to increase in value significantly. The call or the put, one of those sides, and we have sold $3 wings that are giving us a zone that we kind of want the stock to move to. We want the stock to basically move close to the expected move. And this puts us at about $8 away from the current stock on both sides for our short strikes. The expected move is $10. So what we're trying to have happen is the decay and collect this premium that we're selling in the 3-day upfront and still maintain some of the value that we're buying in the 24-day. Does that make sense? At all? Jaden?
Not really. I'm confused.
Okay, so there's 24 days on the expirations to the one that we buy. If you buy a call and the stock goes up, the increase in value, the call will increase in value, right? If you buy a put and the stock goes down, the put will increase in value. But we also sold in a shorter expiration in 3 days that will expire in 3 days and be gone. We want those to expire worthless in 3 days. So we collect against those longs that we bought. We want this collection here of 112 and 65. So we want to collect that $180. We want that to go away in 3 days. And then we're still going to own these long contracts. So we want in 3 days, we want the grand total value in these long contracts to be worth more than $343. And we want these short contracts to be worth nothing. Does that make sense?
I think so.
Because if these are worth more than $343 and these are worth nothing and they expire, then we can turn around and sell these that we still own for more than $343.
Yeah.
And in order for that to happen, you want the stock to be somewhere close to one of these short strikes at the end of the 3 days. Tracking?
I think.
And also in this particular trade, the most that you can lose is $338. So it's less risk. You're not going to make a ton of money in this trade, but it's much less risk.
Yeah.
So go ahead, let's put that puppy on. I like that trade. Send it. And you're filled. Bada bing, bada boom. All right, let's go back to yours, Abraham. You didn't get filled, so we're gonna have to do some price discovery here. Is this yours, Abraham? No, it's not. This is still a big account. This is still your account, Jaden.
That's Abraham's account.
This is your account, Abraham? No, it's not. Net liquidity, 10,132.
Yeah, you have to click on Abraham's account.
Abraham, you have to share your screen.
He is. You have to
Oh,
click
you have to
on-
go to your account, dude.
No, you have to click on his. You have to click on his screen.
Oh, that's my bad. I am the idiot. Oops. All right. Yeah, cancel replace. And then take it down 3 cents. Review, send. Go ahead and do it again and put it all the way down. These wide markets, man, they get you. Might not even get filled here. And you filled. Look at where you go. Go to working or go to filled. No, go back. Look at where they filled you after all that. They filled you at 73 cents, even though you tried to sell it for 72 cents. Isn't that silly? All right, go back to working. Or go back to your account. We'll do a quick recap. So tomorrow morning, I am not going to be here. I am going to get Eli for. So you guys need to log into your account. I'm gonna look at them with you.
Okay.
But I'm gonna be. I'm gonna get into. I'm probably gonna be on the plane or landing. So we might have to set up a phone call and look at it together online on the phone. Because you're gonna want to take these off and keep an eye on them. You may not want to take them off immediately. Oh, the other thing that I didn't cover is normally in a earnings trade, you would trade that front month, that front expiration, the 3-day expiration. We didn't do that. So the value in these contracts is still gonna have juice in them, because we have 20 some days for them to still, for the stock still to move. So we're not gonna see contractions like we did in your stock, where we only had 4 days left at the time that we put it on, and we took it off the next day. So there's very little time. So the only thing that mattered pretty much was how much that stock moved on earnings. The rest of the value almost instantly came out of those contracts. It won't be the same in the 24-day expiration, because there's still several weeks left. But you will see a compression in volatility, and you will see them take that pricing out of this contracts. So it just won't be as dramatic. So we're not gonna be trying to make, 60% of the credit that we collected or 70% of the credit that we collected. We're gonna be happy with 30% of the credit that we collected. If we come in and say we collected $100 and we're able to buy it back tomorrow for $70, that's a win. Does that make sense? Because there's still lots of time left with these contracts, but we're not putting these positions on thinking that they're gonna go all the way until expiration. If we need to manage them, we might have to change that, but as of right now, we're planning on closing them tomorrow, hopefully for a win. Make sense? Now, the only one that's a caveat to that is the one that you put on, that's called a double diagonal spread that we did, by the way. So it's a combination of a diagonal and another diagonal on both sides of the market, which is a calendarized spread with 2 different strikes. Meaning you buy a call in one expiration and you sell a call against it in another expiration. Usually you're buying the call with more time and selling in a closer expiration against it. And that's what we did. But if it were the same exact strikes that we bought and sold, which you can do, that would be a calendar spread. We did a diagonal spread. So 2 different expirations and 2 different strikes. You won't remember that, but after I tell you it 10 more times, you might. All right, guys, thanks for tuning in to Noobs. This is a short little episode, but I hope it was helpful to you guys. The more that you watch this, the more that you follow along. Open a Thinkorswim paper account and follow along with these trades or similar trades, and it will come to you over time. Hearing it, doing it, and just repetition. It's like anything else. The more you put in, the more you get out. Thanks for watching.
Papa Bear in the suit, Wall Street goals, teaching young cubs how to play the role. Market watch stacking cheddar, noob with the knowledge, nobody does it better. Options game, tight calls and puts, stocks flipping quicker than they flipping the goods. E-trade dashboard, money to print, boys learning well, following the blueprint. Noobs in the game, making gains. Papa showing hustle ain't just chasing chains. Trading like gangsters, setting the reins. Teaching them the street of ball and financial domains. Bull market, bear market, riding both tides. Papa got the boys all trading with pride. Short sell, long buy, never DeFi. Family hedge fund, fortunes can't hide. IPOs popping, reading the cues. Charts full of knowledge, breaking the news. Swing trading, day trading, grooving the moves. Shout out to the fan, puts of the trade ain't loose. Noobs in the game, making gains. Papa showing hustle ain't just chasing chains. Trading like gangsters, setting the reins. Teaching them the street of ball and financial domains.